Hi, my name's Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat, and I was a high school personal finance teacher, and I'm a personal finance columnist. I've been an investor since I was 19 years old, so I'm coming up towards my 50th birthday, so I've been investing in the stock markets for 31 years. I want to talk about stock market investing for beginners, and this is the third part in this series. Today I'm going to be talking about the most common product most people use to invest, which is called the actively managed mutual fund. I think it's really important to understand what they are and how they work, whether you choose to use them or not. If you walked into a bank or if you spoke to a financial advisor and you said, look, I'd love you to invest money for me, what they would do is they would put your money in an actively managed mutual fund. Probably 99.9% of the time, that's where your money would go. Well, in the UK and in Australia, these are known as actively managed unit trusts. They're essentially the same thing. They're called mutual funds because it pools mutual money. So let me explain with this example. You walk into a bank and the financial advisor says, hey, we're going to get you into this one. It's the Fidelity US Large Cap Fund. And they would probably get you into a series of different funds, but I'm going to just give you an example of one to start. Let's assume that I am a chartered financial analyst and I work for Fidelity and I run that fund. Well, your money then would get directed into an account that I'm going to be managing. But so too would a whole series of other investors' money. That's why it's mutually pooled. Because it's Fidelity's, and again, I'm just using Fidelity as an example, I'm assuming I work for them. It's a large cap US stock market fund, which means that I actively trade only large US companies. So that's all I buy. So it could be like ExxonMobil, or Walmart, Facebook, Microsoft, just really, really big companies. And my job is to buy what's hot and avoid what's not. So I've got my finger on the pulse of the economy. I'm looking at potentially political policies. I'm looking at projected earnings rates for companies, which companies I think are going to do well. So I'm trading in and out, trying to make the most money that I can on behalf of my investors. So I mentioned that most people would have more than one fund, often for what we talked about in session 2 or part 2 was the process of diversification. My fund itself, that large cap US fund, would have dozens or hundreds of companies within it, but that's not enough just to have large US stocks. And so say my colleague next to me, let's call my colleague Jill. Jill runs, let's assume, an emerging market fund, an actively managed emerging market mutual fund. And so within that, what she does is she again takes pooled monies from different investors, and she's going to be buying shares that are from, let's say, Chinese companies, Thai companies, Brazilian companies, Malaysian companies. So if it's an emerging market, they're from the developing market world. So she's just buying shares, buying and selling, trading, trying to make money on behalf of the people that invest in her fund. Let's say at the office next to him, we have another chartered financial analyst. His name is Tim. He is running a, let's call it again, Fidelity Developed Market Fund. And so in that case, he's just buying shares of companies from developed European markets. Let's just say England, France, Germany. So that's a developed market fund. His job is to trade, to try and make money on behalf of his investors. We also have other categories of funds. So perhaps just a few doors down in a different office, there might be a fund manager named Wilma, and Wilma's job is to run the Fidelity Small Cap US Fund. A small cap fund is a fund that is filled just with small stocks. Small cap stands for small capitalization. It just means small businesses, that's all. Small businesses generally have at least high growth potential. And so she is trying to buy and sell small companies to make money on behalf of the investors who end up buying her fund. You'll sometimes see different categories like mid-cap, so that's mid-sized companies as well. Then there are the other categories such as value stock funds and growth stock funds. These are also very, very common. A value stock fund is such that it's filled with businesses that are generally cheap relative to business earnings. So right now we're in the middle of the COVID-19 financial crisis, and I'm going to guess that a company like Boeing, the stock price has probably dropped a lot because they're not selling airplanes. As a result of that, it might be considered a value play, something that you could buy really, really cheap today that 5 or 6 years from now, or maybe even 10 months from now, you could feasibly sell at a really significant profit once they start selling airplanes again, once airplanes get up in the air again. So this would be considered potentially a value play. And so a value fund manager would fill their fund, or would be trading stocks within their fund, and the stocks would be considered like cheap, right? Kind of like the underdogs. On the flip side, we have growth stocks. So you could have somebody running a Fidelity's growth stock fund. That would include stocks that would be high flyers that people have really high expectations for. So today they might be companies like Amazon, Tesla, Apple, Netflix. And so the fund manager running that would be buying and selling stocks within that fund to make money on behalf of their investors. So again, they're active traders trying to position themselves to buy and own only the best stocks and to trade in and out of them. So another really popular category, one that's growing in popularity, are socially responsible funds. So I might have a colleague running Fidelity's socially responsible, actively managed fund, and his job might be to look at companies that have really good, solid human rights track records, for example, and environmental track records, strong socially responsible funds whereby he's not going to be looking at oil companies, oil and gas companies, companies that deal with pornography or tobacco or alcohol or gambling. So they're known as SRI funds. So he's running a socially responsible fund, and again, he's trading stocks in and out. Session 4, I want to talk about the cousin of these particular products called the index fund or the ETF. We're going to look at whether the statistical odds of success are better with you investing in an ETF or an index fund, or whether they're better going with an actively managed fund. If you buy an index fund or an ETF, well, I'll just be really honest. You walk into a bank, they're not typically going to sell you one of these products. So we'll find out why at session 4. If you like this, you found this useful, please subscribe to the channel, click like, toss a comment or two in, and everybody stay safe. Thank you very much.